40.23. That is the number that should concern every investor watching this channel. It is the Shiller P ratio of the S&P 500 as of January 2026. The only other time in history we witnessed valuations this disconnected from economic reality was in 1999. Moments before the dot-com crash vaporized 80% of the Nasdaq. But if you believe 2026 is simply another cyclical market correction, you are missing the forest for the trees. We are not just staring at a recession, we are facing a convergence of four systemic failures: a sovereign debt death spiral, a commercial real estate implosion, a consumer credit collapse, and a geopolitical stranglehold on critical resources. While the mainstream financial press distracts the public with narratives of a soft landing, a silent, brutal war is being fought in the shadows. It is a war between the US dollar and physical reality. It involves the strategic maneuvering of China, the desperation of the Federal Reserve, and the one asset that stands at the intersection of industry and monetary history: silver. Why are central banks hoarding hard assets while encouraging retail investors to buy overvalued tech stocks? Why is the paper price of silver stagnant while physical vaults are being drained at record rates? Today, we analyze the mechanics of the coming collapse and why the world's largest institutions are fleeing into the metal that the system is trying desperately to suppress. To understand why the metals market, specifically silver, is primed for a historic repricing, we must first dissect the macroeconomic fire burning down the house. The narrative for 2026 is not based on speculation. It is a mathematical certainty, driven by four converging crises. First, the commercial real estate cliff. We are witnessing nearly $1.5 trillion in commercial real estate debt maturing. Between now and the end of 2026, these loans were originated in a zero-interest rate environment. They now need to refinance at double the cost. Simultaneously, office vacancy rates in major U.S. economic hubs have exploded to between 20% and 30%. The collateral is impaired, debt service payments have doubled, and the regional banks holding these loans are technically insolvent. This is not a liquidity issue, it is a solvency crisis. Second, the concentration trap. The equity market has become a dangerous hallucination. A handful of companies, the so-called Magnificent Seven, now represent over 30% of the S&P 500. Investors are paying 40 times earnings based on an AI boom that mirrors the 1999 internet bubble perfectly. The market is pricing in perfection in a world that is fundamentally breaking apart. When this concentration unwinds, there is no diversification to save the index. Third, the consumer breaking point. The U.S. consumer, the engine of the global economy, is exhausted. Look at the auto loan market, the true leading indicator of consumer health. Subprime auto delinquencies have hit their highest level since 1994. Repossessions are skyrocketing. When Americans stop paying for their vehicles, their only means of getting to work, it signals that they have already maxed out their credit cards and depleted their savings. The consumer has no capacity left to absorb a downturn. Fourth, the sovereign debt doom loop. The U.S. national debt has breached $38 trillion. Interest payments on this debt now exceed $1 trillion annually, surpassing the entire U.S. defense budget. The government is borrowing money simply to pay the interest on previous borrowing. In 2008, the Federal Reserve could print its way out because inflation was low. In 2026, with inflation sticky and debt to GDP at 120%, the Fed has no ammunition left. This vulnerability has not gone unnoticed. Across the Pacific, a rival superpower is capitalizing on this weakness, making a move that could shatter the US dollar's hegemony. This brings us to the core of today's analysis: the silent economic war between the United States and China, and how it is quietly cornering the silver market. The China strategy: dumping debt, buying resources. In 2008, China helped stabilize the global economy by purchasing U.S. debt. In 2026, the strategy has inverted. China is shedding US Treasuries at a rapid pace. By selling US debt, they force yields higher, increasing the pressure on the US government's interest payments and destabilizing the American banking system. This is a form of financial asymmetric warfare. But where is that capital going? It is not sitting in cash, it is flowing into physical commodities. Beijing understands a fundamental truth. In a sovereign debt crisis, the entity that controls the resources dictates the terms of the new economy. They are aggressively stockpiling gold, but more strategically, they are securing silver. The industrial monetary paradox: silver sits in a unique position. Unlike gold, which is largely hoarded, silver is consumed. It is the most conductive metal on Earth. You cannot have the green energy transition. You cannot have massive solar farms. You cannot have electric vehicles, and you certainly cannot have the advanced microchips powering the AI revolution without massive amounts of silver. We are currently facing a super squeeze scenario defined by three factors: the supply deficit. For 5 consecutive years, global silver demand has outstripped supply, mines are depleting, and ore grades are falling. We are literally running out of accessible silver at current prices. The paper illusion: the spot price of silver is largely determined on the futures market, where billions of ounces of paper silver, contracts with no physical backing, are traded daily. This mechanism has kept prices artificially suppressed, creating a false sense of abundance. The physical drain. While the paper price lags, physical inventories at major exchanges like the COMEX and the LBMA are hemorrhaging. Strategic accumulators and industrial giants are taking delivery of the metal, removing it from the system entirely. The corporate and banking maneuver. We must also look at the behavior of the major Western financial institutions. For years, banks have held massive short positions on paper silver. While this appears to be a bet against the metal, a deeper analysis suggests a different motive. Price suppression allows for the accumulation of physical metal at a discount. As the 2026 crisis accelerates and the US dollar loses purchasing power due to the debt spiral, capital will inevitably flee from financial assets like stocks and bonds into hard assets. Gold is the primary monetary shield, but silver is the volatile, high-utility asset that benefits from both industrial panic to secure supply chains and monetary panic to escape currency debasement. We are seeing a scenario where the green agenda of the West clashes with the economic warfare of the East. Western governments are mandating a transition to renewable energy by 2030, yet their high interest rate policies have crushed mining investment. China, controlling a vast portion of the processing capacity and supply chain, is tightening the noose. By squeezing the physical availability of silver, they gain leverage over the West's technological and energy future. The year 2026 marks the end of a 40-year debt supercycle. The soft landing narrative is a psychological comfort blanket designed to keep the public invested while institutional capital exits the market. The convergence of the commercial real estate collapse, the sovereign debt crisis, and the bursting of the AI equity bubble creates a massive liquidity vacuum. In financial history, such vacuums are always filled by tangible value, commodities, land, and precious metals. The suppressed price of silver is the calm before the storm. The depletion of physical inventories, combined with the strategic accumulation by China and industrial giants, suggests that the paper pricing mechanism is on the verge of breaking. When that link snaps, price discovery will be brutal and rapid. The question every investor must ask themselves is this: when the credit cycle turns and the banking algorithms freeze, what do you actually own? Do you own a digital promise from a government drowning in debt? Or do you own the essential physical assets that the future economy requires to function? The warning signs are flashing red. The debt is unsustainable, the consumers are insolvent, and the East is buying what the West is selling. So 2026 will not just be a crisis, it will be the greatest transfer of wealth in our lifetime. The only variable left is which side of the transfer you will be on.
There's a saying in the intelligence community: don't look at where the bomb went off, look at where the getaway car is speeding away. In financial markets, we're conditioned to look for noise. We fixate on the massive red candles when the Fed hikes rates. We obsess over headlines screaming about economic collapse or the chaos of the midterm elections. But right now, if you mute the TV and look at the S&P 500 weekly chart, you see something strange. You see boredom. The price churns. It rips up, slams down, and returns to nowhere. To the average retail trader, this looks like a dead zone. They call it a bear market. They're exhausted. They're checking their accounts less and less. And that is exactly the point. Boredom is the ultimate weapon of the institution. They bore you to death before they squeeze you to death. If you peel back the layer of apathy and look at the flow data, you see a completely different story. You see a war zone. Billions of dollars are being silently injected into this market through massive limit buy orders via dark pools. Someone is standing at the gates of hell. Someone is absorbing the entire panic of the crowd without flinching. We are not witnessing a crash. We are witnessing the loading phase, and you need to be on the same side as the loader. To understand what is happening, you have to understand how smart money hunts. If you are a massive pension fund or a Wall Street giant, you don't buy when the sky is clear. You buy when the crowd is distracted by political theater. Let's turn on forensic analysis. The data from MarketWatch isn't just statistics, it is a crime scene footprint. Since 1942, through world wars, inflation, the dot-com bubble, and the 2008 crisis, there is one rule that has never been broken: the Year 3 effect. Look at 2010, look at 2014, look at 2018. In every single instance, the second year of a term was a bloodbath of volatility. Why? Because of uncertainty. Wall Street hates uncertainty more than bad news. They pull capital, creating a liquidity vacuum where price swings violently. But here is the detail the mainstream media misses. Wall Street has a cruel nickname for this specific setup: the pain trade. The market always moves in the direction that causes the maximum amount of financial misery to the maximum number of people. Right now, look at the sentiment data. Retail traders are holding record levels of cash. Hedge funds are net short. Everyone is hedged. Everyone is expecting a crash. So if the market rips higher, who gets hurt? The shorts get incinerated. The skeptics get left behind on the dock. The algorithm is designed to hunt their liquidity. It feeds on their regret. Watch what happens the second the polls close. In the 12 months following a midterm election, the S&P 500 has a win rate of 100%. I repeat, no exceptions. The whales look at the chart and see a spring compressed to the point of explosion. This flat price action isn't indecision, it is algorithmic accumulation. They are programming bots to buy every time you panic sell. But how does the price physically move up? What is the mechanics of the explosion? We need to talk about the VIX crush. Leading up to the election, everyone buys put options for insurance. This spikes the VIX, volatility index. Dealers on the other side of these trades are forced to short the market to hedge themselves. This creates artificial selling pressure. But the moment the election result is known, the moment the event passes, that insurance is no longer needed. The crowd sells their puts. The VIX crashes. And here is the magic. When the VIX crashes, the dealers are forced by their own risk models to buy back the market. This creates a feedback loop called a Vanna rally. As volatility dies, price rises. As price rises, shorts cover. As shorts cover, price rises more. It becomes a self-fulfilling prophecy of buying power that has nothing to do with fundamentals and everything to do with market plumbing. The silence you see now is just the calm before the VIX implosion. Now, combine that technical explosive with the fundamental trigger, gridlock. Why does political chaos cause the market to explode? The media tries to scare you with the word gridlock, political stalemate. They say the government will be paralyzed, but to the financial elite, government paralysis is nirvana. Think like a CEO of a trillion-dollar empire. What do you fear most? New taxes, new antitrust laws, surprise regulations. When Washington hits gridlock, the legislative gears jam. No new taxes, no surprise laws, total status quo. This triggers the CapEx unleashed phase. For the last 18 months, corporations have been hoarding cash, afraid to invest because they didn't know the rules of the game. But once gridlock is confirmed, that fear evaporates. The board of directors gives the green light. They start building factories. They start buyback programs. They start M&A. We are seeing a rotation from fear assets into growth assets. The smart money is positioning themselves for a 2-year runway of unhindered corporate earnings. It's like driving on a highway, knowing the police have gone to sleep for the next 2 years. What do? You floor it. We are in the final seconds of the accumulation phase. The psychological trap is set. The dips you see in the coming weeks, those are stop hunts, final liquidity sweeps designed to shake the last weak hands off the train. But remember the concept of the price vacuum. When the shorts are forced to cover and the sideline cash chases the rally, this double-engine demand hits a market with zero supply because the whales have locked up the float. This is how you get vertical moves. This is how you get melt-ups that leave rational analysis in the dust. Once the election passes, price doesn't just climb, it teleports. It gaps through resistance zones like they don't even exist. The most dangerous emotion right now isn't fear, it's the temptation to sell too early. When the breakout happens, your brain will scream, "Take the profit," but you are trading pennies in front of a steamroller. The year 3 trend isn't a trade, it's a regime. It lasts for 12 months, not 12 days. What is your strategy? Don't try to fight the whale. Execute the drafting strategy. Place your buy orders right here in the accumulation zone. Place your stop loss right below the concrete floor the whales have built. Don't let the media fool you with headlines about political division. That division is rocket fuel. The whale is fully loaded. The departure signal is flashing. The only question is, when this train leaves the station and hits the vacuum, are you sitting in the seat or are you standing on the platform watching it disappear? On December 5, 2025, Reuters did something that made all of Wall Street hold its breath. They dropped a bombshell article labeling gold's rally as bubble behavior. Their message was crystal clear. Prices have risen too fast, 60%, the highest performance in 46 years. Sell now before it crashes like it did in 1979. According to conventional logic, when this news hit the wires, combined with rising US Treasury yields, gold should have nosedived. Investors should have panic sold to lock in profits. But the unthinkable happened. Gold didn't crash. It didn't even blink. It swallowed that bad news whole and stubbornly continued moving sideways at all-time highs. This isn't resilience. This is a terrifying anomaly. Why would an asset labeled a bubble by the media and being net sold by ETFs refuse to go down? Has the market gone insane? Or is there a shadow force silently scooping up every single ounce the moment it hits the floor? Welcome to Financial News. Let's rewind the tape and dissect this crime scene. We're going to find out why the old laws of supply and demand are dead. Look at the data Reuters accidentally exposed but didn't explain in depth. They call this a bubble. But bubbles are usually driven by retail mania, the euphoria of the crowd. But look at this chart. Gold holdings in ETFs like SPDR are 10% lower than their 2020 peak. Gold miner stocks are still languishing at the bottom. What does this mean? It means the retail crowd, people like you and me, are not buying. In fact, Wall Street is selling. So the billion-dollar question is, who is buying? And how aggressively are they buying to absorb the selling pressure of the entire Western world? The answer lies in the vaults of central banks. According to Goldman Sachs, these whales have been net buyers of over 1,000 tons of gold annually for the last 3 years. But here is the detail the mainstream media ignores. They aren't buying on the public futures exchange, where you can see the volume. They are operating in the opaque over-the-counter markets in London and Switzerland. This is a stealth operation. By keeping their massive buy orders off the public order books, they prevent the price from exploding too early. They are using iceberg orders, buying massive amounts of physical bars while the public price, determined by paper contracts, stays suppressed. Compare this to the China silver dump. When the London market ran out of silver, China had to flush their stockpiles to save the price. But with gold in 2025, the situation is the exact opposite. The West is trying to suppress the price using news and derivatives, paper gold, but the East, China, Russia, India, is standing underneath, catching every single bar of physical metal. This is a reverse squeeze. On the COMEX, for every 1 ounce of registered physical gold, there are now hundreds of paper claims trading against it. It is a game of musical chairs played with dynamite. When the music stops, there won't be enough chairs. They are draining the physical liquidity. Reuters calls it a paradigm shift, but the accurate term is the depletion of Western inventory.
Why are they hoarding so frantically? Why don't they trust the dollar anymore? Let's look at the death spiral mechanism that the article only cautiously hinted at. Reuters compares 2025 to 1979, but this comparison is mathematically flawed. Phase 1, 1979, US debt was only 30% of GDP. Paul Volcker could raise rates to 20% to kill inflation and save the dollar. Phase 2, 2025, U.S. debt is 4 times higher than in 1979. Budget deficits are running at 6% of GDP annually. Here is the deadly trap. If the Fed raises rates to stop gold, the U.S. government goes bankrupt because it can't pay the interest. If the Fed cuts rates to save the government, inflation explodes and gold goes to Mars. This is no longer just about economics. It is geopolitical warfare. Daniel Oliver from Myrmikan Capital pointed out the exact moment the system broke, the 2022 seizing of Russian reserves. When the U.S. weaponized the dollar, they sent a signal to every sovereign nation: your savings are only yours if we agree with your politics. That shattered the trust that took 80 years to build. You can't print trust. Once it's broken, the flight to safety becomes a permanent migration, not a temporary trade. The Fed's balance sheet is bleeding because it's stuffed with long-term bonds that have lost massive value. Their gold coverage ratio is now only 16% of their liabilities. Think about that. The entity issuing the world's reserve currency is technically insolvent on a mark-to-market basis. Do you see the parallel with the silver market? In silver, it was a physical shortage due to industrial demand, solar. In gold, it is a shortage of trust due to fiscal collapse. The U.S. cannot print more gold. They can only print more dollars. And the central banks know this. They are exchanging paper that is about to lose value for the only real asset left. They aren't buying for profit. They are buying for survival. So, what is the next scenario? Look at the math, because math doesn't lie. Currently, the gold price is rising solely due to smart money, the whale, buying pressure. The crowd, the retail, hasn't even joined yet because they believe articles like Reuters claiming this is a bubble. And here is the psychological trap. The article wants you to look at the nominal price, $3,000, $3,500, and think it's expensive. But priced in purchasing power, priced in gallons of oil, priced in hours of labor, gold is still cheap. The bubble is in the currency you're holding, not the metal you're watching. But what happens when Western inventory runs dry? Just like silver, when the vaults in London are empty, price will no longer follow any technical analysis. When individual investors realize bonds are no longer safe and stocks are too risky, they will stampede into gold. But at that moment, who will sell to you? The central banks? No, they're buying. The ETFs? They've been net selling for 3 years. Their vaults are emptying. We're facing a supply shock on a global scale. Reuters calls it a paradigm shift. I call it a repricing. Gold isn't rising. The value of currency is free-falling to its true value, zero. Don't let the headlines fool you. They scream bubble to shake the tree, to scare you into selling the little gold you have left. Don't sell your insurance when the world's financial house is on fire. The physical supply shortage is about to be exposed.
I am monitoring the inventory data at COMEX and LBMA closely. There are signs that we are scraping the bottom of the barrel. If you want to receive an early warning alert when the physical squeeze signal officially triggers, comment "Gold Squeeze" below. Remember, in this game, you cannot use policy to fight math, and the math is on gold's side.